While there are a number of regulatorily approved reasons for banks to purchase BOLI, most of them use it to offset the cost of providing employee benefits. Just to be clear, that's including existing employee benefits costs such as healthcare costs and 401k matching contributions, or new benefits such as a salary continuation program for retaining key executives.
We like to think of it as two different facets. One is a tactical facet, that is offsetting existing employee benefits that the bank have, bank-wide potentially. The other is strategic, that is we design an executive benefit program that is specific to retain and reward folks that work at the bank, and BOLI is used to offset those costs as well. Banks should review their existing BOLI program. In fact, if they own it, they are required to review it annually. But in addition to reviewing it annually, periodically they want to look at it at the policy level to determine, are individual policies also performing as they would expect? Secondarily, they want to make sure that if they've used it to offset a benefit program they've put in place, that there's not an exposure that is uncovered over time, and that the BOLI still performs and does and covers that exposure that they expected to have covered when they initially put in the benefit program in the first place.
We like to do a deeper dive to make sure that the trend of the rate of return of those BOLI policies isn't going down, and compare it to the outside world to see if there might be some improvement to be made by maybe doing an exchange for some other policies. There are three types of BOLI products available in the marketplace. That's general account, separate account, and hybrid account products. Community bankers are typically looking to the general account and the hybrid account products for their portfolios. The separate account product is available for larger banks, but really isn't available in the community bank marketplace because of the economies of scale that the separate account products need to make sense for those types of community bankers.
The asset size of a bank, more correctly, the capital size of a bank, can dictate how a bank looks at utilizing BOLI. So if you're a large enough bank in capital size, there's breakpoint pricing to be potentially garnered in looking at purchasing BOLI. So the larger placement that you can do with BOLI with an individual carrier allows you to get a little better yield with your BOLI due to that breakpoint pricing. Well, certainly with the new tax law having lower tax rates, BOLI is not going to have a tax equivalent yield that is quite as high as it did prior to the beginning of 2018. However, BOLI being an annually repricing asset, in a rising rate environment, it's going to increase over time behind that, and not being subject to mark-to-market allows BOLI to be a very stable asset for the banks to utilize, particularly in an asset liability match against an employee benefit.
We feel that banks are going to be much more profitable now, and with that, and a heating up economy, we hope, that the bankers will need to look to programs to keep their best people. And how do you pay for that? The BOLI is the best way to pay for that.